continue to look at the charts, analyzing technicals in a market that is rotating the recent rotation. We've got tech in the NASDAQ up, and reopened stocks are lower today. Joining us from StockCharts.com, David Keller is the Chief Market Strategist. David, welcome back to the show.
Good to see you, Oliver.
Thank you. Appreciate it. Let's start with some companies that have been out front. Let's go to financials first, as we've got bonds rallying the last couple sessions. Banks have been coming under pressure expectedly. What do you see for the potential for the buy the dip or an actual rollover?
So I was taught by an early mentor, never confuse the top of the page with resistance. So when interest rates rise, we can come up with all these reasons why they shouldn't go above a certain level. And I don't think we're done with rising rates. Rates have come off a little bit, as you mentioned. Bonds are having a nice bounce, which is arguably very much overdue. You had, sort of an exponential rise in rates. You had an exponential rise in stocks like JP Morgan and regional banks and others that had pretty good rallies. And they all sort of ended up in that overbought territory where they'd had a pretty established run. So arguably the best thing to happen if you're bullish on financials, bullish on regional banks and things like that, is a healthy pullback. Gives you an opportunity to get in at a lower level. And I think we're starting to see that sort of rotation. The XLF, if you look at all of the 11 S&P sectors and look for a decent, strong uptrend in the last 3 to 6 months, financials are probably pretty high on the list of things that I would argue fit that criteria, along with things like industrials and others. But certainly a pullback, a tactical pullback, which I would argue we're in the middle of here, would give the chance for bonds to rally a bit before the next leg higher in rates, which I think will fuel the next move higher in a lot of the financial stocks that have already had pretty good runs, but I think have more to go.
So you're saying we should view this as kind of a mean reversion kind of pause, but basically something that we don't want to get trapped into thinking that the old normal's back?
I think a lot of people are getting sucked in by the rally in technology, the pullback in sort of the value trade, and thinking, all right, that was it. This was just a fluke, and now we're going to see, tech go to the moon again. I don't think that's necessarily happening. The divergences you saw in a lot of the technology stocks, semiconductors, the chart of semiconductors comes to mind as just this really clear bearish divergence signaling uptrend exhaustion. I don't think we've had enough pullback, enough correction in terms of time or price to really alleviate that sort of signs of euphoria that we saw in a lot of technology names. And the same thing with the run that you saw in financials. It's all about your time frame. If you're a swing trader, I could see looking at some of the regional banks and seeing pullbacks to their 50-day as being a great actionable short-term move. But it's all about the longer-term trend for me and a lot of our customers. And so for us, I think it's about understanding how that tactical weakness fits into the long-term trend. And I'm looking at a chart of JP Morgan. I see a long, strong uptrend with potential pullback space to get down to an ascending 50-day moving average. The uptrend resumes, and I think it's a fairly orderly rise from here.
Okay, I like the JP Morgan reference. We're looking at the overall bank group right now, which has, of course, had quite a bit of relative strength next to the S&P, I believe is what you're charting here in the bottom panel. And we can see that elevation is plateaued a little bit, kind of looks like what we see in some of these companies like JP Morgan that you mentioned. But I guess for a theme to take hold, it has to make people question it, right? Give enough doubt so that it can continue to create pain on the way up. David, what about for semiconductors? I think this is such an interesting part of the market and a really crucial one, because if you want to think tech will do well in a cyclical upturn and an economic recovery, the chips seem like they've got to perform. What do you see in this right now?
So semiconductors, again, arguably a great bellwether group to watch. And just one of the key ratios I look at is just the relative strength of the semiconductor index. If that's outperforming overall, the conditions can't be that bad. And if it's underperforming, conditions can't be that good, regardless of what you may think should happen or could happen. What we've seen with the semiconductor index, though, I think future books on charting will refer to the bearish divergence that you saw with the semiconductor ETF, the SMA. So you saw these higher highs January into February of 2021. You see lower highs in momentum, and coincidentally, that's a lot like what the chart of the S&P 500 looks like now, where the index keeps pushing to new highs, but on lower and lower momentum, which tells you there's less and less juice, there's less fuel behind each of these moves. So arguably what's happening, I would say with the semiconductor ETF is It's pulled back. I think undercutting the low from earlier this year was a key tell. I think we've bounced a little bit off of that low, but I see that as more of a short-term bounce before another leg lower. I think semiconductors and broadly technology, when you see the rallies like you saw yesterday, but on lighter volume, it wasn't a super impressive rally. It was more of like a quick bounce off of a low. I still see the path of least resistance is lower. However, if you're looking 6 to 12 months down the road, I think arguably you're setting up a really good entry point on groups like semiconductors that are long-term outperformers, stocks like Intel, with decent charts that are holding up okay. So I think over the long term, there could be some great opportunities to enter in on a weaker levels, but I still think there's more pain to be had. I've not seen the disbelief phase play out enough on a group like semiconductors yet.
Is there any head and shoulders concern? I mean, we kind of were looking at that back in February.
So that's exactly right. You have, and when I mentioned undercutting that low from earlier in the year, you have the higher high going into the new high for the SMH. Then you made that lower high, and then you undercut that previous low, and that's a classic head and shoulders top. What a lot of people are talking about now is if you look at the very short term, you could arguably see a bit of a head and shoulders bottom, an inverted head and shoulders. I think that is more of a wishful thinking analysis at this point. For me, I think that broader rotation that we've seen and breaking below that low from earlier this year, that head and shoulders top and starting with the weakening momentum that we saw going into the head, going into the ultimate peak, I think that tells the story about the next 2 to 3 months. I think it's a rockier road for technology and for semiconductors. Okay,
so still thinking about the original body shape that was forming as opposed to the kind of growth on the shoulder of another one. I was getting kind of confusing there. Okay, so David, still kind of looking with some concern at the semiconductor group. You've targeted Microsoft in your report in particular from this chart, as earlier this morning we talked about the stock in the context of possibly buying Discord, but it does kind of stand out. I mean, it looks quite a bit different than a lot of stuff out there right now, at least kind of from my layman's perspective.
So I think you hit on a really good point, Oliver. If you oversimplify and just think about allocating to technology or buying the NASDAQ or buying, a value fund, we've gotten very comfortable as investors doing very passive bets and thinking big picture about rotations. And for a lot of people, that's totally fine. But I think as a stock picker, there are plenty of opportunities out there. And when you're talking about an entire group, you're talking about technology, a stock like Microsoft actually stands out. I think what's most telling on this chart is that second panel down, which is the RSI. That's the measure of price momentum. And if you look, for most of the last year, the RSI has remained above 40. And what happens when a market is in an uptrend, when a stock's in an uptrend, it'll have moves higher and then it'll pull back a little bit as it digests that last move, and the RSI will remain above 40. That's sort of a traditional entry point. What happened at the beginning of March is you had that same pattern. We pulled back, the RSI hit a bottom around 40, which is similar to what we've seen in previous pullback. So I think there's certainly long-term, a chart like Microsoft, I don't have a problem with. The question is, what's the tactical play between here and the next month or two? And I see some further downside on a stock like Microsoft, which gives you a better entry point. The 200-day moving average is not too far below. It's around 215 or so, which would be 15 points below where we're at. I wouldn't mind accepting that sort of pullback and getting in at a good entry point on a long-term uptrend. But overall, the trend characteristics are pretty strong, and stocks like Microsoft stand out as decent trends that tend to be holding up. Okay. So Microsoft doing better than the other ones, for sure, looking like it is steady, to your point about the relative strength and the RSI. I mean, just very calmly staying elevated relative to a lot of else out there in tech, especially, even looking better than semiconductors we were just watching. David, if we shift over and kind of connect to some of the thematic things, yesterday we spoke with Dave Nadig, and he was walking us through ETFs that folks are looking at as kind of policy proxies. One of them that he mentioned is also on your list today, PAVE. The chart looks pretty amazing on this thing. I mean, what's there to say here? It looks like it's pretty steady up and away. So, when I was asked, at the end of last year, thinking about plays for 2021, infrastructure stocks were pretty much at the top of my list. And the reason was because from, looking at the elections last year, one consistent theme with both of the final presidential candidates was the need to invest in infrastructure. They need to rebuild the economy, relaunch things, and invest in what was going to allow us to get there. And I think you've seen a lot of that play out just with the charts of industrials and materials and charts like Deere and Caterpillar overall, which have had pretty decent runs so far this year. But PAVE is an infrastructure ETF that has good exposure to the types of companies that are going to help the economy reopen and expand over the course of the year. I think that's what we will continue to do. I wish it was a direct line A to B as how it's happening. I think we're seeing a lot of headlines suggesting headwinds and then tailwinds to coronavirus vaccines and reopening and all of that. But I think what the chart of the PAVE ETF, infrastructure ETF, shows you is that there's a consistent belief that there's a reopening happening. There is potential upside, further upside in the types of companies that are going to help us do it. If you look across the investable universe, PAVE stands out as something that's not overextended. It's not something like a Viacom or Discovery, which had euphoric rises. And it's not something that's struggling. It's just sort of this nice, consistent uptrend, consistent outperformer. And in general, if I had a portfolio of things like this that were consistently outperforming with minimal drawdowns, I'd probably be pretty comfortable with it. So PAVE, I think, sets up really well here, not just for what we've seen so far, but I think for the potential for the rest of this year, too.
All right, very steady in its climb and potential here. David, one more to get an update on. It looks like you are willing to nibble on some gold at this point from what I see in your notes. A bold move on what was the worst chart for a year.
So I am not naturally a contrarian, Oliver, as you probably know from coming on your show. I like charts that are going up, and
certainly not a gold bug.
No, and I've learned from working with institutional investors in general, follow stocks that are working, lean into what's working. Right. But I'm tempted on something that's like gold that has had such a tough run. It's recently oversold, and it's bouncing off of a key support level. This level that you're showing, and it's basically bouncing off of the 61.8% retracement. If you start the clock at March of 2020, go to the peak in August of 2020, we've hit the last Fibonacci support line. This is the last line in the sand, and it lines up beautifully with the lows you saw last April, May, June, before it rocketed up to the August high. So it's retraced all of that move. It's given up a lot of ground, and it's sort of at that last point. So from a risk reward perspective, it seems like something you could get into. You have manageable risk on the downside and the potential to regain some of the upside. We haven't seen inflation, fears really materialize, and I would argue the chart of gold going higher would be that indication. But I could see that happening. I could see things pointing that way over the course of the coming months, which would mean gold would have a nice bounce. If it breaks 1675, though, I would be holding on for the potential for much further downside. 1450 would be the next level down from that, which would be a painful run.
Yeah. Okay. All right. So it either finds some support and finally turns this thing around, or if we fail, then we look at some major breakage again ahead. So depending on one's view here, I guess it is kind of a high magnitude kind of straddled trade, looking for something in one direction. David, great stuff. Always really like your take on the charts. Thanks a lot.
It's a pleasure, Oliver. Be well.
Thank you. David Keller is the Chief Market Strategist at StockCharts.com.